Hey guys, welcome back to another video. So we are halfway through the ICC T20 World Cup in India and Sri Lanka for 2026. Over the last couple of weeks, there's been 3 games a day. There has been plenty of trading opportunities, and there's been some bits that I've spotted that, with the new format of this World Cup, has given opportunities to some valuable or value plays, I should say, with the very short price favourites of member nations and affiliate nations. So I've made this video looking at the underdog effect and profiting from the biases in live cricket trading where that may be the short price favourites, I believe, in my opinion, are slightly too short. So we're going to get into this video. I'm going to have a little look. I've got some bits that I can show and sort of what I'm thinking. So common misconceptions. Everyone says follow the favourites in sports betting, right? So what if I told you that the biggest profits in cricket trading come from betting against the expected winner? So what I mean is everyone thinks that the very short price favourite is going to win. But if we go against that trend and actually look at the value in these odds, there is money to be made. The price never goes in a straight line to 1.01, for example, on a 1.05 favourite. So we're challenging a theory in live sports, revealing that the underdog effect and how psychological biases can line your pockets, how we can make profit from looking at these short price favourites and effectively laying them to a higher to, well, it's laying a low price to back at a higher price. So let's see. So what do I mean? What are we looking for? So far, during the 2026 T20 World Cup, there have been 40 games in the group phase. There's been a mix of affiliate nations playing with member nations, and this has caused a unique situation with odds, especially creating short-priced favourites. So, the member nations in this T20 World Cup have been starting off as low as 1.03 and can range up to 1.15. This has been a unique factor in this World Cup due to the format. Obviously, it's changed format this time round, so all of the 20 teams that have been in the World Cup are playing against each other. It's been very entertaining. The affiliate or smaller nations are actually becoming very competitive in these games, which is creating really good trading opportunities. It's creating really good swings. There's value, and it can be a bit of a goldmine. So obviously in trading, we're not selecting an outcome and letting it run. We're not betting on what we think is going to happen. We are trading events. So we are expecting that some of these underdogs are actually going to be competitive. I'm not saying that they're going to win, but we're going to say that we think the prices of the short price favourites are going to slightly drift. And that is the theory behind this sort of strategy as such, is that when you have a very short price favourite, if, for example, they lose 2 wickets very quickly in a power play, their price is going to jump up. And we can gain an advantage from that as traders of laying them and backing at the higher price. So let's look at some graphs that I've been keeping an eye on. I've been taking some screenshots, and there's been some really good games. Obviously, a lot of these have ended in the Zimbabwe-Australia game, for example. This is the graph. Australia started at 1.1 here. So they were odds-on favourites. And as you can see, I think this is just the first innings graph. The prices just went straight up. So if we'd have looked to lay for £100 at 1.1, our liability is £10. So effectively, the worst thing that can happen is Australia take 10 wickets very quickly. Zimbabwe score no runs, and the price hits 1.01 and we lose £10. But what actually transpired in this game was, well, Australia didn't play well and Zimbabwe won. So a strategy here would be lay at 1.1 with a short price favourite here. And actually we could probably look to get out at maybe 1.3, 1.35. The £100 lay at 1.1, and if you did cash out at 1.35, you'd have a hedge profit of around £18.50. So that is straight away with a maximum of £10 liability. There's 185, well, £18.50 profit from a maximum liability of £10. You could obviously slowly drip out your funds as well. So if you laid at 1.1, you do £5 at 1.15, £10, 20, 30, until you get up to slowly feeding out. But this example, the first example, obviously, it's a good example. The next one we've got is England-Italy. Now, this game was very interesting. I didn't get the final graphs for this, but I've got a first innings graph where actually the latter game, it did ebb and flow, and there was a lot of swings in this game. But you can see England started at 1.03, and the price moved above 1.1. So say we backed at 1.03 for £200, or we laid at 1.03 for £200, and we looked to cash out at 1.1. Our maximum liability £6. So the worst thing that could happen is it hits 1.01, it does not move, we lose £6. But actual fact, it dropped down to 1.02, shot up to 1.12, came back down again, and then obviously it did actually keep coming up and down later in the game. So again, if we lay £200 at 1.03 and we cashed out at 1.1, so we gave ourselves a bit of actually, I think England may start getting a hold of this game. We're actually looking at about a £12 profit there from 1.03 to 1.1 with the £200 sort of laid stake with a maximum liability of £6. So there is value here. Again, Canada, New Zealand. This game again, very, very interesting. Look at the starting price of New Zealand, 1.04. You can see that graph there. There was two very big swings. You could have got in twice on this one. Of say we got in at 1.04, laid for £100, maximum liability £4. So we could, the worst possible outcome, we lose £4. But actual fact, it went up to 1.16, 1.18 here, and dropped back down again to 1.06, and then shot out to 1.2 again. So if we'd have got in at the off at 1.04, laid for £100, maximum liability is £4. If we'd have got out at 1.16 here, we would have stood to made a hedge profit of around £10. And again, from a maximum liability of £4, actually the upside is quite good. So, but like I mentioned, you could actually look at this, do it twice. But this has been a bit of a recurring theme, and as we see here, India, Netherlands, started at 1.03, and immediately Abhishek Sharma obviously got another duck in that game, and the price just went up and up and up, and India struggled in this game. And if we'd have laid £100 at 1.03 and cashed out at 1.13, so here, just before it went above 1.15 and dropped again, if we'd have got out just here, we'd be looking at an £8 profit with a maximum £3 liability. So again, this is relative to say a £100 bank, for example. So we can lay for £100 and the liability is very small. Obviously, imagine scaling this up to bigger sort of numbers. So say you had £1,000 bank, you could lay £1,000 with a liability of £30 and stand to win 80 or 100 or £120 from these. It's obviously relative to your bank size, but again, there are these anomalies that I have seen all throughout this tournament. I know I've selected these 4, but there's been 40 games that have gone on where actually the favourites haven't all had it their way. So in summary, is it worth laying the short price favourite? So I think yes, but not every time. I think research is needed. You need to see, are the team too short? Is there bias that's driven this price down? Is it, for example, like the India game where they are the home team, the home nation, not been playing the best cricket, but should they be at 1.03 in that game? I thought no. And actual fact, you could see that their price went up. So there are lots of opportunities in the World Cup. I think now that we're going into the Super 8s, it will be limited, but I still think there may be 1 or 2 shorter price favourites that can be exploited by this. When is the best time to identify this? So going forward, the World Cup is going to be keeping this format. So in the T20 World Cup, that is. So we should start to see more short price favourites contesting these World Cup games in the future. Occasional T20 series between member nations and affiliate nations do have these kind of short prices. I think recently the West Indies played Namibia as well, and the prices were quite short. but you don't see a lot of it in domestic cricket or in domestic T20 cricket. The prices are normally quite balanced in that you're normally looking at maybe a favourite at 1.6 and an underdog around 2.4. So it's sort of not. It's more in the international cricket in tournament plays that you see this. And what is the risk? So the risk is you have to be comfortable that if it does all go wrong, that you are going to lose your stake, because if it does hit 1.01 and does not move, then we can't really recover that. You have to be comfortable or willing to take the risk to get the reward. It's very rare that a market will move straight down from a short price. There is normally some sort of movement, the odds change, especially in a short price favourite, whether it be 1 tick or 10. It's just sort of judging how you see the game going and how or when the best time is to exit a trade or take the profit and be comfortable with, have you made the right choice. Like I said, it's just managing the risk and managing trades relative to your bank size and not overstaking and using, say, the 1-2% of the bank that you've got. So thank you for watching. I know this is a bit of a short video, but I spotted this and thought it would be good for people sort of looking from afar or trying to get into this kind of trading, that in these World Cup games you do get short price favourites that can be exploited for market bias, where people are looking to always back and make a lot of money from betting at 1.03, for example. But actual fact, if you take a step back and think over the course of a game, is the price going to stay under 1.03, 1.05? 95% of the time it does sort of drift off higher, like I said, between 1, 10, 20 ticks. And this is all profit that we could be making slowly and surely. So thanks for watching, and keep an eye on some of the cricket games and see if you can spot this, or if you have got in and traded this, then hopefully you've made some profit.